Okay, well, we're going to talk a little bit more about the creation of partnerships and the establishment of partnership capital balances. Obviously, some of you are struggling with this concept, so I thought if we did a lecture in this style, that perhaps it might help you a little bit. So what I've done is I've set up a spreadsheet that I think will help you to see how I go about solving these problems, and perhaps it'll help you do that as well. What I want you to do is look, we've got a problem, we've got a partnership. It's currently Crab, Apple, and Cove. They have a partnership that has, if you'll notice down here, a total of $1,100,000 in total capital. Crab has a capital balance of $400,000. Apple has a capital balance of $250,000. Cove has a capital balance of $450,000. They currently share profits. 30% of the profits go to Crab, 50% to Apple, and 20% to Cove. This partnership is considering adding a new partner, Worm, if you notice over here. And Worm is going to pay $150,000 into the partnership in exchange for a 10% ownership in the partnership. So once Worm invest the money, they will have 10% of the partnership, and the others obviously will have less ownership. The three currently have 100% between them. They'll only have 90% between them when this is said and done. So how do we account for this? Well, if you recall, there's 4 different ways to go about accounting for the admission of a new partner into a partnership. And the first way we're going to look at is what we call the book value approach. And in the book value approach, there's 2 options. One, the cash can go to the partners. The other, cash can go to the partnership. Now that's a difference, because if it goes to the partners, then the cash never hits the partnership. It just goes into the pockets of the partners, and the capital of the partnership hasn't changed. If cash is going to the partnership, then not only are the existing owners going to give up some ownership, but there's new capital has come into the partnership, so the partnership's total capital has in fact changed as well. So what we're going to do is look at how we go about this. So let's assume that Worm is going to put $150,000 into the partnership in return for a 10% ownership. So how do we do that? Well, first thing we're going to do is start with our entries. What we know is, and let me do a little math down here, the current partnership current balance is the $1,100,000. In addition, we're going to have a new capital. In this case, the new capital is 0, because the capital is not going to the partnership, it's going to the partners. So the capital isn't going to change. So new total capital is still, as we can see, still 100,000. I'm going to make that just a little wider there so we can see it. So still 1,100,000. So the entry becomes pretty simple. All we're going to do is take these existing capital balances and take away 10%. So we're going to debit. They currently have credit balances. We're going to debit each of these partners. Crab is going to get debited for 10% of their partnership. 10% of 400,000 is 40,000, and we can actually compute that. 40 times 0.1. Apple is going to lose 10% of their partnership balance, which is 250 times 0.1. And Cove is going to lose 10% of their balance, which is 450 times 0.1. So, and I'm going to reformat these here so that they are just one digit. It just makes life a little easier. Now, so the credit to Worm is simply going to be the sum of those. Now, if I post this, since no new capital came into the partnership, these balances will change. Worm will have a balance, but the total should stay the same. So let's watch what happens. I'm going to put 40,000 debit into Crab, and you'll notice that Crab's changes to 360,000. I'm going to put 25,000 into Apple and 45,000 debit into Cove. And then what I'm going to do is I'm going to create a $99,000 Oh, I made a little mistake down here. Let me go back and fix that for you. I referenced the wrong thing. The existing balance is 400,000, so that will be 40. It'll be actually the beginning balance times 0.10, the beginning balance times 0.1, and the beginning balance times 0.1. Well, if I could learn to do my math right, beginning balance times 0.1, beginning balance times 0.1, and that beginning balance was 450,000. So now when we post our entries, we got 1,100,000. When we post our entries, 40,000 goes here. We're going to debit Apple for 25,000. We're going to debit Cove for 45,000, and we're going to credit Worm for 110,000. And what we see is we still have 1,100,000 in our total capital for the partnership, but now Crab only has a balance of 360, Apple has a balance of 225, Cove has a balance of 405, and Worm has a balance of 110. So let's go through and redo this problem a little differently. Let's assume now that what we have is a situation where the cash is actually going into the partnership. So 150,000 is coming into the partnership. And you'll notice here that the partnership capital, if we look down here, is now, I'm going to highlight this in a nice bright color for you. Let's highlight it in green, light green. There we go. 1,250,000, which means there's an extra 150,000 in capital in this. So the first thing we have to do is allocate this capital to, this is bonus to the members. So we will allocate. First thing we got to do is add the cash to the partnership. So cash is going to go up by 150,000. Next thing we'll do is we have to spread this. We have to spread the balance to these new partners. Now we've got several. One of the things we're going to have is we're going to have Worm. Worm is now going to have 10% of the new partnership. Worm is going to have 12,000. Or no, excuse me, 125,000 is going to be Worm's balance, because Worm, remember, gets 10% of the partnership, so it's 125,000. Is what Worm is going to get. Now, how do we do this other? We got a $25,000 difference. Well, it's going to go to each of these partners. And each partner is going to be getting a bonus. Now, what they're going to get, well, the difference is 25,000, right? So, and I can find that by simply saying, 25,000. It's this 150 minus this. It's 25, but it's 25,000 times the profit loss sharing. This is like a bonus that there's a $25,000 bonus going to these partners, and they each get a percentage of that. Crab will get 30%, Apple will get 50%. Cove will get 20%. So I'll simply multiply that difference by the profit that Crab gets. I'll do the same thing. It'll be that $25,000 difference times the profit sharing or profit percentage that Apple gets, and it will be the same 25,000 times the profit percentage that Cove gets. And so I'm going to post these. Now I'm not going to post the cash balance, but let's post each of these and watch what happens to the capital balance. It should change. We should have a new capital for the partnership of 1,250,000. Let's see if that's what happens. I'm going to post 7,500 here. I'm going to post a credit of 12,500 in Apple, a credit of 5,000 for Cove, and a credit of 125,000 for and I'm going to actually add these up here. And sure enough, we've got a balance of 1,250,000 for the total partnership, 407,500 for Crab, 262,500 for Apple, 455 for Cove, and 125 for Worm. I'm going to suggest that you need something set up like this, because if you don't have something set up like this, it's going to be very difficult to remember what's going on. So I always like to do the entry and then post the entries. I think that works better. Let's go now look at the third version of this, and this is a version where of this problem where we're going to use the equity method or the revaluation approach to this. Obviously, Worm is paying in $150,000 to the partnership, so Worm's contribution is 150,000. Worm is getting a percentage of 10%, and if you figure that out, that means that the partnership capital should be take 150, divide it by the 0.1, should be 1,500,000. Let me put the formatting on it. 1,500,000. Currently, we've got a balance of 1,100,000, which means there's $400,000 in goodwill associated with this new investment. So how do we do this? When the capital goes first to the partners and second to the partnership. So we have to figure out how to do this. We're adding some new value to the partnership, and we have to account for this goodwill that's coming in. Since we've got a difference of 400,000, that is goodwill that will be attributed to each of the existing partners. This is recognizing the value that they added to the business. We're going to treat that almost like income to them. It's value that had previously not been recognized. We're simply recognizing this value, and since we're recognizing that, we have to allocate it to each of the partners. So the first entry we're going to do is where we allocate the $400,000, which is the difference between the $1,500 implied value and the $1,100,000 current capital. We're going to allocate that to the existing partners. So we'll create an asset called goodwill, and that's going to be 400,000. We know that. Now, for each of the partners, we're going to have to allocate that 400,000 to them. So Crab is going to get the 400,000 times 30%. Apple is going to get the $400,000 times 50%. And Cove is going to get the $400,000 times 20%. And so we're going to post this entry. So we get 120 here, 200 here, and 880 here. Now, what I want you to notice is the new implied partnership, the new capital is 1,500,000. We've added this implied new value of 400,000 to the partnership. So now all we have to do is do a second entry, and we'll simply allocate this. So Crab, Apple, and Cove, and we're going to allocate it to Worm. This is just like we did in the first example for bonus. So the difference is we had to first create the goodwill and create and add new capital and sort of bump up the basis of the partnership. Then what we're going to do is allocate that new basis to Worm. So Worm is going to get 150,000. We know that because that's what they put in. And in a revaluation approach, whatever the new partner puts in, that's what their new capital will be. So we know that much by definition. So Crab will give up 150,000 times 10%. Excuse me, that's not right. Crab will give up 520,000 times 10%. they'll give Apple will give up 450,000, 10% of their balance, and whoops, I didn't do that right. And Cove will give up 10% of their balance, which is 530,000. And when I post this, it should reallocate these partnership balances, should create 150 here, but the total should still be 1.5 million. So let's see what happens. I'm going to put 52,000 in Crab, a debit to Crab. I'm going to put 45,000 as a debit to Apple, and 53,000 as a debit to Cove, and I'm going to put a credit of 150,000 in Worm, and lo and behold, my capital balance did stay at 150. I reallocated all those, so my four balances are now a total of 1,500,000, and Worm has 150,000 in their balance, and we can now see the balances for the existing partners. So let's look at one final example, and that is when the cash goes into the partnership in a revaluation approach. So we're going to add that 150,000 actually into the partnership, which means partnership actual capital is 12,250. The implied value is still 1,500,000, which means that the goodwill now is going to be the difference there of our 150 minus our 1,250,000, or 200. So we only have goodwill of 250. So we're going to do this again. We're going to do a couple things here. First, we're going to add the first thing we do is we're going to take this 250 and allocate it to the new partner. So we're going to have goodwill of 250. So there's the goodwill of 250,000 that we're going to record. Then we're going to allocate that goodwill to the partners. And it'll be just like before. Crab will get 30% of that. Apple will get 50% of that 250. And Cove will take the goodwill, and we'll get 20% of that. So we're going to post those, and we'll post 75,000 for Crab, 125,000 for Apple, and 50,000 for Cove. Now the next step is simply to do a second journal entry where we debit the cash. We recognize, remember, cash goes into the partnership, so we have to recognize that. And all that will be attributed to the new partner, Worm. So we post that into Worm's account. And sure enough, our new balance is 1,500,000, just like it should be. We've actually allocated the 250,000 of goodwill to the existing partners. They all have new balances that have been updated with a total of 1,500,000 being the new capital balance for the partnership. So I want you to go back through this and see how I set this up. The key is to do your journal entries. Don't try to skip this part. I suspect that many of you are skipping this piece, and you're not actually going through and paying attention to the to the journal entries and posting them to T accounts. You have to use the journal entries, and you have to use T accounts. I've been doing this for 35 years, and I can promise you I cannot figure out a way to do partnerships reliably, consistently, and get the right answer if I'm not using the T accounts. If I don't use them, I can't get the right answer. I can't do it in my head. And so I'm suggesting that it's probably difficult for you to do it in your head as well. So go back through. Remember, there's two approaches: bonus approach and revaluation approach. Each approach has an option where the partners can pay the new partner can pay their cash either to the existing partners or into the partnership. So if you do your problems the way I've done it here, I think you will be much more successful in being able to account for various partnership capital balances.